What's going on, penny boys and gals? It's your boy, What the Duck here, and it is time for another trading class video. This is a bonus trading class. Today's topic is going to be things that you can do during a red day, meaning when the market is red, which does happen, and it's important to know how to manage that, like the person right over here was able to do. So let's go ahead and get right into the video, right into the class. So we're going to go ahead and go to our handout. This is a handout that you can find in our free Discord. If you go to the free trading classes, completely free to everybody, you don't have to be a paid member. You can just click this right here and it'll take you to the handout. So here's our handout for trading on the red days or trading during a red market. As Benjamin Franklin said, an investment in knowledge pays the best interest, meaning before you start earning, you should try to start learning. Learning leads to earning. If you try to start earning before learning, you're going to learn that you should have done exactly that. You should have learned, because otherwise your portfolio might end up in and earn. And now that I thoroughly hate myself for saying that, let's go ahead and go to the bonus video. So the stock market is red. All of your stocks are red. Everything's going down. Facebook, StockTwits, Webull, everyone's freaking out. So now what? First thing you can do is manage your emotions, which we go over in Penny Boys University. We have 5 courses going over trading psychology. Is the whole month going over trading psychology, because trading psychology is so important, especially when the market is red. As you can see on the left, that's a heat map showing that the market is just that, red. And if you don't know what a heat map is, then you can definitely check out our Penny Boys University course called Trading Tools. That's in our Penny Boys University program, where we go over a bunch of different trading sites and tools that you can use, like FinViz, which has just this, a heat map, as well as a bunch of other free trading sites that you can use for your trading. So back to the course. So trading during a red market. Well, if you're able to trade during a red day, chances are green days will be a lot easier for you. Kind of like when a baseball player puts a donut, or it's like a weight, on their bat when they're about to hit next. They do that because it makes the bat feel heavier when they're swinging it. That way, when they go up to bat for real, the actual bat they're holding feels lighter because it has no weight on it, whereas you were just swinging it with the weight. Now it's lighter. It's the same thing with the market. Being able to trade during a red market, being able to manage your emotions during a red market is kind of like being able to swing that bat with a weight on it. Now, when the market's green, you take that weight off, it's easy to swing, so it can be a lot easier for you to manage your emotions during that green day than a red day. But there are complications that go along with both, so you definitely should be checking out our trading psychology courses in Penny Boys University to figure out how that all works. So let's go ahead to the next page. So one emotion that you might have is the fear of loss, or loss aversion, is the fear of losing. Because as humans, we naturally have this built into our DNAs. We react 2.5 times greater to loss than to gain. So it's really important to be aware of this, especially when you're making decisions in the stock market, especially during red days, because you're using your hard-earned money and you don't want to lose that. So when you see all of your stocks going down, you think to yourself, well, if I sell these now, will it be because I'm trying to protect my portfolio? Is it because I'm trading based off of my plan? Am I making a smart decision right now based off of technical fundamental analysis and my plan? Or am I doing it because of my emotions, because of my fear of losing or my loss aversion? Because there is a difference between being careful and being fearful. Their form of fear is panic. In a red day, a lot of traders start to panic sell. This means that, they're just making on-the-spot decisions without using logic or reason, without using technical or fundamental analysis. They're just panic selling, which is part of the loss aversion, the fear of losing. You see the stocks going down, you're like, all right, I got to get rid of everything. I don't want to lose anymore. If you're just doing that based off a split, logical decision, then this is all you're trading with your emotions, not based off of a plan. Just because the market is red today or this week does not mean the sky is falling. So just take a breath, evaluate your positions, and as well as the market, and see what works best for you and for your plan, and make a smart, educated decision. Not one based off of your emotions, not based off of panicking, and not one based off of greed. So you're up on a lot of stocks. So you see the market is going down, as are some of your profits, but you refuse to sell because you want to see more profits. Stocks go up and stocks go down. So, maybe just, the market's red, take some profits. You can always buy back later. There's no reason to be greedy when it comes to profits, because profit is profit and profits add up over time. It's all about managing your risk to your reward. We go over in Penny Boys University, we go over how to use a risk to reward based plan, how to integrate that into your trading plan. Another thing that you could have that could negatively affect you in the stock market, especially during a red day, is being over optimistic. So maybe you got into the market when it was, on the rise. All the stocks have been doing really well since you started trading. You think to yourself, nothing can go right. Right? You think to yourself that nothing can go wrong. Right? Well, that's wrong, because the stock market is a dangerous animal that does not care about your emotions or your financial situation. It's always important to limit your risk. Like I said, things do go wrong in the stock market. It's always going to be green. Some days you will have red days, which is why you want to limit your risk. You want to manage your risk and manage your emotions. So the stock market goes up, but it also goes down, like I was saying before. So don't let yourself get too comfortable in a green market, because it might end up clouding your judgment during a red one. Which leads me to my next point, overconfidence. So like same deal, you've been killing it in the market. All your plays are hitting target. You're making a lot of money. All you see is green. You think there's nothing that you can do wrong. Again, that's not right. That is wrong. Because a lot of traders refuse to sell when they feel this way, when they feel overconfident. Because they don't want to be wrong. It's okay to be wrong. It's okay to sell for a loss. That's how we learn. So you've been making all this money and you see one play going down. You think to yourself, no, I'm a really good trader. I've been making so much money. I was right about this trade. I wasn't wrong. I'm not going to sell for a loss because that means I'm wrong. It's okay to be wrong, because if you are overconfident or stubborn, which is another emotion, well, then you could end up holding that bag because you didn't see that, it was going to, you are wrong sometimes, and it's okay. And, it's better to limit your loss and be okay with being wrong than to be stubborn and end up holding a bag or selling for an even bigger loss. Kind of leads to blind hope. Kind of a little bit different, but also kind of the same. Stocks are all down. You let them go past your stop loss because you think to yourself, I'm a long-term investor now, or, you don't lose until you sell. That's what creates bag holders or stagnant accounts, meaning all your money is locked into a bunch of bags, a bunch of red plays, whereas you could have, sold for a little bit of a loss and then use that money to make wins or profit elsewhere. Instead, now you just have a bunch of money just stuck in these red stocks. And as a trader, that's not what you want to do. If you're a long-term investor, that's okay if you want to hold things long. But we're traders. We want to be in and out of trades, and we want to have money to make money on those trades. And you can't do that if all your money is locked into a bunch of red plays, of bags. So, blind hope is not, you can't will a stock to go up. The stock market does not care about what you want or what you hope for. The stock market just does what it wants to do. Another emotion that you could have is that an emotion of giving up. So this can happen in two different ways. So either a trader might give up altogether and think that the stock market is too hard, where trading education is so important. But we have Penny Boys University so that we can learn from our mistakes as opposed to just give up because of mistakes. We are human, and stock trading is not easy. Have you ever tried to ride a bike? Chances are, if you didn't have training wheels, your first time ever riding a bike, you might fall over. Have you ever tried skiing? Chances are you're going to fall down before you get really good. And it's like anything in life. You fall down sometimes, and you dust yourself up, and you get back up, and you learn from your mistakes. Get better because of it. So another form of giving up is seeing a red account and deciding to sell everything and to start over, which sometimes is okay. A reset can be a healthy way to get your emotions back on track and develop a new trading plan, because sometimes when you try to have a new trading plan or try to do a little reset and you have a bunch of red plays, seeing all that red might make you go away from your plan because of your emotions. Seeing all the red, it might make you feel in a certain way, and you start trading based on your emotions as opposed to your plan. So sometimes a reset is good, but only if it's based off of based off of your plan, based off of a good decision, as opposed to just everything's red, I'm bad at this, and just giving up and starting over based off of your emotions or based off of fear, whatever it may be. It's okay to reset, but you want to make sure that you're doing it for a good reason. Back to my first point, a lot of traders end up quitting, within their first 3 months, and that's because they don't know what they're doing. They get in there thinking that it's easy. The stock market is not easy. If it was easy, everyone would be doing it and we'd all be rich. But that's just not how it works. There are winners and there are people who sell for losses in the stock market. Our goal is to educate ourselves so we can be on the winning end. don't give up. You're not bad at trading. You just need some education, or maybe you're just not trading based off of your strengths, which is why we go over trading psychology in detail so you can identify your strengths and your weaknesses and trade accordingly. Another mentality you can have that could negatively affect you in the red market is a chaser's mentality. So you see your portfolio is red, you think to yourself, I gotta make this back, and I gotta make this back right now. You go to the Webull top gainers list, or you see, you go to the stock twits comments, or whatever it may be, you see a bunch of rocket ships getting posted, so you decide to throw money into a stock just hoping to make up your losses by chasing a top gainer or just chasing what everyone else is talking about. And this could usually lead to even more losses because you're not trading based off of a plan, you're not trading based off of a good setup, you're just literally just gambling. You're just hoping that, if you throw money into a random stock, you're going to make your money back from your losses. And that is the chaser's mentality, which usually does happen a lot of the times when your portfolio is red and you think you're feeling a certain way, you're starting to feel emotional and you want to make those losses back. So, emotions lead to even more losses in this case. You can end up losing, which leads to a red portfolio, and then the red portfolio leads to emotional trading, which leads to making emotional decisions in trading, which leads to more losses, which leads to more emotions, and then keeps on going over and over and over again. You don't want to get stuck in that cycle. You don't want to gamble. So, one way to help determine if the stock market is just having a pullback or is showing signs of a crash is to use the free trading sites that we went over in Penny Boys University to do your due diligence, or even just go to our Penny Boys Discord and just ask questions. It's a great resource for education as well as the stock alerts. Education is key. So, if the market is red, what you can do is you can bet against the market. You can make money when the market's going down. What this would be is trading a put. The option. Options are very risky. I would not recommend this if you don't know what you're doing with options. But you can go over options. In our education classes, we actually go over options in detail in Penny Boys University, in the alumni bonus classes, as well as our Penny Boys advanced classes, and we even have an Options 101 class in Penny Boys University. And our advanced classes are actually done by James Legends, which is our options shot caller. He is amazing at options, and he does live streams. I believe it's every Sunday. So, it's definitely worth checking out. So, another way to bet against the market is puts. I don't want to go over that in too much detail because we do go over that in Penny Boys University and in the advanced classes and in the bonus classes, but it is very risky, which is why I'm not going to go into it in too much detail today. Another way, and a little safer way to make money when the stock market is going down, are inverse ETFs. These are bearish ETFs that go up when the stock market goes down. An ETF is an exchange-traded fund, so basically a bundle of stocks or commodities that you can buy and sell as one entity, just like you can with stocks. You can buy and sell stocks, or you can buy and sell ETFs. But ETFs, instead of just being one stock, is a bunch of stocks or commodities bunched together. So these can be bought and sold just like stocks, like I was saying, but is a lot less risky than shorting, which we'll go over, or getting puts. We go over shorting in detail in Penny Boys University. Once again, a very, very risky way of betting against the market, so I don't want to go over it in too much detail today. But if you join Penny Boys University, that's where you can definitely find information on that. So there are ETFs, or exchange-traded funds, for all sorts of things. There's one for airlines, which is JETS, for gold, JNUG, or even oil, UCO. These ETFs are a bunch of stocks and commodities bunched together, in certain areas, whether it be airlines, oil, gold, or, for instance, with jets, instead of investing in American Airlines only, you invest in jets, which is an ETF, which is a mix of a bunch of different airlines. So it's like, it could be like 10% American Airlines, 7% Delta, 6%, whatever other airline. A bunch of airlines all put together. And you would do this if you're bullish in airlines, because jets goes up, airlines go up. So if you're bullish in airlines as a whole, as an entity, you don't want to limit yourself to just one airline, then you can buy the ETF. Because if you only buy American Airlines, and let's just say American Airlines just doesn't do well, due to financial news or just bad news or earnings, but airlines are still doing well in general, you're still making money if you're in JETS versus the ETF, as opposed to just being in American Airlines only. This is kind of like, if you play fantasy football, this is kind of like, instead of having 8 players all on the same team, you have one player on each team, That way, if one team does not do well, you're not going. Your whole fantasy football team won't do well if you have 8 players on the same team. Whereas if you have one player on each team, one team doesn't do well, like the Jets or the Giants don't do well, and you have one player on that team, that's okay. But if you have 8 players on that team, they don't do well for that day, then your whole fantasy football team is not going to do well. Here's an example of the Jets ETF. So as you can see, it has a 10% of Southwest Airlines, 9% Delta, has 9% American Airlines, it has some United Airlines holdings. There's a bunch of different airlines all put together, different percentages that equals ETF. And these are the top 10 ones that JETS is holding. So here's a few more examples. You have a JNUG, which goes up when gold is up, and JDST, which is the bearish, goes up when gold goes down. UCO goes up when oil goes up, and SCO goes down. Right? SCO goes up when oil goes down. Also goes down when oil goes up. And you can also bet against certain markets as a whole, like SPXL and XPXS. So XPXL goes up when the S&P 500 is up. XPXS goes up when the S&P 500 is down. There's TQQQ and SQQQ, which do the same thing for the NASDAQ, with TQQQ being the bullish one, and SQQQ being the bearish one. And then there are other ETFs as well that you can use, like SPY and IPATH, S&P 500, VIX, other short-term futures, and many others, which we actually do go over in our alumni bonus classes, in our ETF bonus class. But as you can see, you have TQQQ, SQQQ. It's nice to put them in your watch list together. You can see that one goes up, the other one goes down. One goes up, the other one goes down. It's almost identical. And A, it's a good way to see how the market's doing, but B, it's a good way to, the market's going down, to bet against the market, getting the bearish version. So as you can see here, the bearish one went up after hours, and the bullish one went down after hours. So let's discuss now what to look at when an alert is under entry. So, it's a red day, and the alert came out a few days ago, but now, the market's been red. So the alert, let's just say, was, buy at $20. Well, let's say the stock is now at $18. So you see it's way under entry. You haven't even got into it yet. Does this mean it's on a discount? Is it a good buy? Well, picture this. So you go to a car dealership. You see a 2018 BMW 5 Series 530e. I don't know anything about cars, so I have no idea what that even is. I just looked it up randomly. It has 25K miles on it. So you know that, usually worth 30K used for your research. But this one's priced at 20K. So even, so you do your research, you see that this exact car, with 25K miles on it is usually worth 30K used. Right now, this one's priced at 20K. A huge deal, right? Well, why? You want to wonder, why is it a good deal? You're not just going to blindly buy into it because it's a good deal. You want to know, why is this a good deal? So you tell the dealer, well, show me the Carfax. So you see the reports in the car, you do an inspection, it turns out that the engine is busted, the radio doesn't work, the parking brake is stuck, one of the windows won't open, and the lock on the passenger side door doesn't work. Well, thankfully you did your due diligence before blindly buying the car. Same thing goes with the alert. You want to make sure the same thing. You want to make sure that the alert didn't go down because of bad earnings, or the alert is on a discount or has a good deal, because of technical reasons, because the market's just red. That's why it's not a good deal, but it's still a good stock to buy. It's called doing your due diligence. Make sure it's not because of bad earnings or bad news or something that kind of makes the alert obsolete. You also want to go into the Discord, and you want to see, if whoever did the alert, be it Big Quench or Mr. Stock Lot Profits, you want to see what they say about the alert. Maybe they said, oh, this bad news happened, I stopped out for a 3% loss or a 5% loss. So, all right, well, maybe I'm not going to get into this play because they aren't confident in it anymore. However, if you go into the Discord and you see, it's down a little bit, and you see them saying, yeah, I'm buying more, I'm still developing my position because we buy in slow using our PBU buy-in method, which you can definitely check out in Penny Boys University, which is a great way of buying into stocks in a way that limits your risk and gives you a great way of making potential rewards. Like I said, you can check that out in Penny Boys University. That's class number 3. Using this method, buying in slow, you can take advantage of the red days by developing a great average. During the green days, you can make even better profit. So, taking a new alert that just came out that is currently at entry. So the alert just came out. It's currently, the entry on the alert says at $2, and the stock's currently at $2. That's just like buying a car that, is basically brand new. You know, you don't have to do due diligence on a brand new car. It's brand new. You don't even see the Carfax because, you know, there really isn't any. You know, of course, with stocks, you still want to do due diligence on the stock in itself to make sure that, you know, it's stock that you want to get into and it fits your plan. But as far as, you know, seeing as if it's still a good alert based off the actual alerter, you know, if it just came out and it's still at the same price, like a brand new car, it's a brand new alert. Used car would be an alert that might be a week old that went down a little bit or even up a little bit that you want to do a little bit more digging in. And one way, like I said before, of doing this is by using the free trading sites that we go over in detail in Penny Boys University during our trading tools class. Use these to look at the news. You can see the comments that people are saying. You can determine why the alert is under entry and if it's worth getting into or if it's just worth passing, because there's plenty of alerts out there in Penny Boys. There's 10 to 15 a day. It's okay to skip an alert. There'll always be another one. So we also recommend, especially during red, you know, especially for red days, we recommend to keep around 20 to 30% of your portfolio in cash. This way you have capital available, or, you know, money available in your portfolio if there is a red market and you want to take advantage of the dips. You want to take advantage of the price drops. You want to have that cash on hand for those red days. Something crazy happens in the market. You want to take advantage of, like, you know, Tesla forward split or stimulus news, or, you know, it could be like AMC or GME, and you want to take advantage of all the people trading with their emotions. You want to trade based off of your plan. You want to have cash on hand in case that happens, because if a Tesla forward split happens or stimulus news comes out, and, you know, there's all these different potential plays that you can get into, but all your money is in other plays. You don't have any cash on the side. Well, then you can't take advantage of that happening because all your money is tied up. Or if an alert comes out that you really want to get into, you really feel really confident about, it's good to have that 20 to 30% portfolio in cash so that you can use that money to get into that play. So if you're not in Penny Boys University, you can definitely join now at pennyboys.is/pbalerts to get premium stock alerts. We have 30 trading education classes. 22 of them are for premium members. We have a bunch that are available for free members. We also do giveaways. We have cash giveaways and so much more. And you can definitely use WTD15 for 15% off. But yeah, that is the Penny Boys University trading class. This is our bonus class, like I was saying. Going over a red market trading. We have a bunch more bonus classes coming up. Definitely take advantage of. You can go to our Discord and you can check out the free trading classes to see all of our free handouts and the videos that go along with it. So once again, my name is What the Duck, and I hope that you join me next time for the next bonus trading class, so that together we can all make some bread.